The following program is brought to you courtesy of a grant provided by the Bank of Princeton.
Good evening. This is Lou Goldstein, and welcome to another edition of Focus On. Tonight, my guest is Steve Ackmann, who is president of the Bank of Princeton, and we'll be talking a little bit about the banking industry and community banks and why community banks are a good alternative to some of the big name banks that you might be familiar with. But before we get into some conversation with Steve, and Steve, first, welcome to the show.
Great to be here.
Thank you for coming by. I just want to tell you a little bit about Steve. He joined the Bank of Princeton as president back in August of 2010. And prior to the bank, Steve's been in business for about 40 years, the banking business. And he's had an extensive financial services background. He's been an executive with an extensive depth of knowledge and wide range of experience in all aspects of bank management. He was most recently president and CEO of the Fidelity Deposit and Discount Bank. And prior to Fidelity, Steve was the senior executive vice president and chief operating officer at FNB of Pennsylvania. Before that, he served as president and chief operating officer of Promistar Financial Corporation and president of Promistar Bank. Mr. Ackmann earned his MBA from the University of Pittsburgh, the Katz School, and he also has been active with several nonprofit organizations and served as a board member for various nonprofit, community, and business organizations. And it's a privilege and to welcome on the show tonight.
Thank you. Thank you. Great to be here.
Oh, it's great. So, Steve, a lot's going on lately in the banking industry.
Yeah, every day.
Yeah, but first, before we get to that, I'd just like to talk a little bit about the Bank of Princeton, and so everybody gets to know the Bank of Princeton, and why community banks seem to be thriving now in this financial economy.
Bank of Princeton, we started April of 2007. Hadn't been a bank headquartered in Princeton probably for perhaps 2 decades. With consolidation that's been ongoing in the business for years and years. There had been a bank years ago, I think it was the Princeton Bank and Trust, and that had been taken over, and there was a void in the market. Our founders got together as a group and decided that there was a need in the area and raised enough capital, a pretty substantial amount of capital, and we opened our doors April of 2007. It's been a great story since then. We've grown from one branch on Chambers Street in Princeton, in downtown Princeton, to today we're in excess of $600 million in assets, and we have 10 branches throughout Mercer. We're into Hunterdon County, and we have 3 branches in the Philadelphia suburbs too.
So you're growing?
Yeah, we're growing pretty fast.
That's great. That's great. Now, as a matter of full disclosure, the Bank of Princeton is the sponsor for this show.
Yeah.
And you did have the foresight to say, you know, we'll give a shot, and we do appreciate that because it has been very, very.
That's sort of what community banking is all about, though, and we do participate in a lot of local events. So that's one of the beauties of being a community banker.
It's good, and hopefully we'll continue that sponsorship. Well, I want to talk to you though about the impact of global competition and recent international news on the market. How has that impacted a community bank, or does it impact a community bank?
To some extent, it does. I mean, some of the news you're hearing today with the euro problems and the debt problems in some of the sovereign nations tends to be a little remote from us, but those do have impacts every day in the capital markets in our country, interest rates, stock market volatility, and to some extent, just overall atmosphere of what's going on. I think that may put a little bit of a damper on people's ideas of doing things right now. It's been so much bad news over the last couple of years that people seem to have retreated to some degree, and you keep hearing that, I guess in the presidential debates, that there's a certain amount of optimism that needs to be brought back into the picture here. So the euro problems are just another piece of that problem, and as they get some of those worked out, maybe that's one more thing off the table that can help begin a recovery in our country here.
I think one of the big things that people are concerned about too is that, and they're a little confused. A couple of years ago, about 3 years ago, there was a big stimulus package that was offered and passed,
Yeah.
by Congress, and there was cash that was infused into the economy. And over a period of time, a lot of people have seen, banks have profits, but those profits don't seem to be resulting in increased lending by the banks. And I thought if you could help explain that, it would be appreciated.
Part of the problem, I mean, you hear a little bit of a mixed story out there. Some banks are retreating a bit on their lending. Other banks are lending a lot. And it has to do with how you went into the economic contraction that has occurred over the last couple of years here. Some of the banks, what led to the contraction was maybe an over-enthusiasm for real estate lending. A lot of people lent, a lot of banks, particularly community banks, lent pretty heavily to real estate development, particularly home developments around, really all over the country. And as that balloon kind of burst, it caused serious difficulties in the financial services world. I mean, I think we're all aware that since 2008, there's been quite a few banks that have failed and been taken over by the FDIC. In almost every case, it has to do with real estate lending, and perhaps an over enthusiasm for lending into that market. When the market slowed down and stopped, prices declined, forced write-offs of some of the loans. The examiners, the regulators would force you to take write-downs on those loans to reflect what current values are. Those banks see their capital depleted pretty severely, and so banks that were lending into that recession have in some cases had to retract a bit as they build their reserves back up, deal with many problem loans. Other banks, I think there's a story that there is lending going on today. I mean, certainly we're doing a lot of lending. We didn't have a legacy loan book that we had to really deal with. When the contraction started, we were just getting started in business, so we didn't have a lot of loans that would go, that we had to write down. And in fact, as we lend now, we're lending on values that probably are diminished from where they were 5 or 6 years ago. It's been a pretty good market for us, and some banks are doing that. People are beginning to get back into car lending and commercial lending, and certainly there's some real estate lending going on. We're noticing in our business that there's hiring, there's competition for people that are good lenders out there. We hear from recruiters that they're seeking out people that have an expertise in various types of lending, real estate, commercial, things like that. So it's beginning to emerge again. The banks that have the problem are the ones that went in that had difficulties through the recession, typically had too much real estate lending, and they're working through those problems right now.
There was an article in the New York Times last week that I just want to read to you and see what you think. The article talked about lending. It said, normally banks earn healthy profits by taking in deposits and then investing them or lending them out at substantially higher interest rates than what pays savers. But the traditional banking model has broken down. Loans going out are not keeping pace with deposits rushing in. So I don't know if that's been true for all banks. I know Bank of America recently had a big problem. They've laid off thousands of employees. And I guess the question I really wanted to ask you, I know, is that some big banks are charging to hold debit cards. Now, as a community bank, is the Bank of Princeton also charge?
No, we don't charge for that.
So you don't charge at all?
No, no. Most of the community banks would not charge for that. A lot of the headlines have been the big banks, the Bank of Americas, the big regional banks. Wells Fargo has done some different things on the charging for consumer accounts. Over the past decade, part of the profits of many banks, including the larger banks, has come from free checking accounts. Checking accounts free, but there's certain fees that are paid to use the account. Perhaps some places used overdraft fees as a way to generate additional fee income. Debit cards, there's a little bit of income that's generated when customers use those things. There's a fee that the merchant pays when a card is swiped at the machine, whether it's used in a credit format or a debit format. There's a little bit of a residual that comes back to both the network and the ultimate provider of the card. A few pennies, and those have been a part of the profits of the checking account business. Some of that's gone away because of the Dodd-Frank bill, and within that is something called the Durbin Amendment. Durbin restricted the amount of a fee that could occur on a debit transaction to, I believe, and I'm not sure if I'm exactly right here, 22 cents. Typically it was around 40 cents before that, based on the average ticket size and the amount of the interchange fee that would be generated off of that. So those big banks that had billions and billions of debit card transactions saw the revenue from that basically go down by half overnight. So they've been looking around for ways to replace all that revenue, and that's a lot of them, particularly Bank of America, came up with that $5 a month charge. Just reading trade publications today, people are starting to back off of that, and a couple of the bigger banks have started to backpedal on that, and I wouldn't be surprised to see if maybe Bank of America comes up with a different methodology here to do something. There's been a lot of negative pressure here.
Yeah, it's like the extra money you get charged at the airports when you have to take a suitcase on board. You know, there's a lot of pressure on that in the beginning too.
I would argue as a banker that the value of the convenience of using a debit card for a few pennies is a lot better than paying whatever it is, $40 or $80 for an extra bag on an airplane. But I guess everybody looking for different ways to raise revenue.
As far as getting back to loans, do you think for everybody out there, do you think it's easier in working with a community bank to obtain a loan from a community bank rather than a larger bank?
I think it's probably always easier to deal with a community bank. One of the good parts of a community bank is you're close to the management of the organization. If you want to deal with an issue that might be outside of the cookie cutter approach, and most people don't really fit into a cookie cutter approach, community banks, we can tailor products. There's more discussion on rates on loans. If there's problems on your accounts, there's usually